Dividend ETFs offer a number of attractive characteristics. Most notably, dividend ETFs can save investors a lot of time researching companies and potential headaches compared to earning individual stocks, and kept up to date with the latest news. The majority of dividend ETFs hold between 50 and several hundred companies and are well diversified across a number of industries. Purchasing shares of most dividend ETFs provide instant diversification to a portfolio, providing an investor with protection against being overly exposed to a particular sector that falls out of favor. Dividend ETF investors don't need to worry much about constantly monitoring their holdings because many ETFs are well diversified and no single company is likely going to make or break the performance of an ETF. The consistent cash flow from dividend ETFs can also provide more ease for investors instead of solely relying on the stock price and capital appreciation. The bulk of stock market returns have come from dividend reinvestment, leading to the compounding growth over time, which is a great way to build wealth and more passive income. SCHD is an ETF provided by Charles Schwab, who own and operate the fund. Charles Schwab are the ones who actually own the underlying shares in individual companies, so when we buy shares in the ETF, we buy from Charles Schwab, who continually issue new shares in an open-end fund and not the individual companies inside the ETF. Now, SCHD aims to track the performance of the Dow Jones U.S. Dividend 100 Index, which is an index focused on the quality and sustainability of dividends. It invests in stocks selected for fundamental strength relative to their peers based on financial ratios typically characterized by higher dividend yields in the U.S. stock market compared to the broad index. The first quality the ETF looks for is sustainable dividends with financial quality. The indices not only seek to track stocks with consistent dividend payouts, but they also apply a quality screen for the sustainability of yields. They seek what are called quality yields by requiring stocks to have paid dividends for a minimum of 10 consecutive years and by ranking stocks by a composite score, calculated from the cash flow to total debt ratio, return on equity or ROE, dividend yield, and 5-year dividend growth rate. On top of these screens, there is also a monthly dividend review to ensure dividend sustainability, where every month stocks that have canceled their dividends will be removed from the index. The next quality is dividend growth against future rising interest rates. A focus on dividend growth in an environment where market participants are concerned about rising rates may be important. Typically, high-yield equity strategies are biased towards rate-sensitive sectors, which tend to pay out higher yields because of the leverage that they can take on, mainly because of mature business models such as utilities. Such entities are exposed when rates rise. Selection based on dividend growth helps to ensure that firms can develop their business and increase their payouts are favored in the selection process. Such businesses are often well-managed companies from both capital structure and operational perspectives. The next quality is investability. Differentiating the Dow Jones Dividend 100 indices from other dividend strategies are their strict size and liquidity screens and their weighting method, which is based on a modified market cap approach. These attributes were chosen with the goal of increasing index investability in terms of liquidity, capacity, and turnover. Size and liquidity screens could help to reduce the influence of smaller and more distressed stocks on the portfolio than into a liquid basket of constituents. A weighting method based on modified market cap could not only help maximize the index capacity, but it also has the potential to lead to a lower turnover than alternatively weighted indices that weight constituents primarily based off yield or total dividends. Now, to find the ETF in your brokerage account, you'll need to type in the ticker code SCHD to bring up the options to buy or sell shares in the fund. It pays distributions, which are dividends from the ETF 4 times a year, with a yield of 3.26%, and has a management expense ratio, or MER, of 0.06% per year. So for every $10,000 invested, it will cost $6 per year in fees. And this isn't a bill you have to pay straight away. It's automatically taken from how much money you have invested in the ETF's total, so you never notice anything being paid or taken out of your brokerage account. Now, since this ETF tracks the large dividend U.S. companies, it is heavily tilted towards financial and IT companies. The largest portion of the fund, at 20%, is in IT, followed by financials at 19% and consumers at 15%. Materials and energy companies make up the smallest percentage of the fund, under 5% each. Now, ETFs are considered to be a low-risk investment because they're low cost and hold a basket of stocks or other securities, increasing diversification. For most individual investors, ETFs represent an ideal type of asset, which builds a diverse portfolio. Still, unique risk can arise from holding ETFs, as well as special considerations paid to taxation, depending on the type of ETF. Since inception, SCHD has an average annualized return of 14% before tax and a cumulative return of over 300%, which goes to show the power of dividend reinvestment and compound interest, keeping the money invested growing faster over longer periods of time. Now, of course, past performance is no guarantee of future performance, but it's always a good sign of consistently improving business fundamentals, continually driving each individual stock higher within the ETF. We prefer to look at the cumulative returns, as it includes the dividends paid to shareholders, which should always be included, as we're getting some value back. Plus, with the dividends reinvested, this is what provides the compounding effect exponentially, increasing our returns the longer we have our money in the fund. This is the sort of approach investors take investing for the very long term, using ETFs, and one day live off the investment portfolio as passive income through either dividends or selling down small parts of the position but maintaining the bulk of the capital.